2013 and September 2016. And most importantly, Raghu was the chief economist of the International Monetary Fund between 2003 and 2006. I mean, Raghu is quite simply a consummate scholar, a visionary, and who has had a profound impact in academia, in the policy world, and pretty much on anyone who cares about the world of economics and finance. So Raghu, it's a real pleasure to have you join us today. You know, the great thing is we can talk to you about pretty much any topic in the broad space of economics and finance. This conference is on trying to ensure an inclusive and sustainable and resilient recovery. So maybe what we could do is just kick off. Well, let me first set the ground rules. The ground rules are, the plan is Raghu will give us some introductory remarks, and then we will have a bit of a back and forth. But I would encourage everybody who is listening in to post their questions on in Q&A. So I will be monitoring the Q&A. I won't be able to monitor everything. So just make sure you put your questions in Q&A and do that as and when you choose to, because I think it would be great to bring in those questions into the conversation as soon as possible. So that's the plan. We have about 60 minutes, so we have a good amount of time to discuss some very important topics. So Raghu, with this, the screen is yours.
Thank you. Thank you, Gita, and thanks for having me. And of course, I was chief economist at a time when things were very, very benign. In fact, even Argentina was in the process of recovery at that time. And of course, you are living in really unprecedented times and having to work through it. I congratulate the IMF on pushing for a much broader vaccine strategy. It seems to me the failure of vaccine distribution to many parts of the developing world are a taint on global cooperation, and I'm glad that the IMF has made serious efforts on pushing large countries to remedy that. Well, you know, on the theme of unprecedented, let me just lay out some of the issues of today, and then we can talk about remedies and a deeper assessment of much of this. Clearly, the pandemic is unprecedented in living memory, and the fight against it also in many ways is unprecedented. And of course, we've already talked about the distribution of vaccines, on which so much more needs to be done. We've seen an extraordinary fiscal and monetary response, especially in industrial countries. But also this comes at a time when leverage in public systems and private systems was already high. But coupled with leverage, we've had a tremendous amount of innovation, certainly in the financial sector, but also in the real sector. The extent of our automation that's happening is impressive. There's been tremendous differentiation across countries, but also within countries. In many developing countries and emerging markets, it's night and day between the upper middle class and the lower middle class. And of course, you know, surrounding all of this is the high and almost indiscriminate level of financial asset prices, and you know, spoiling the party, the prospect of rising inflation and interest rates. Now, given all this, let me talk about a couple of things which are quite important. I mean, clearly in industrial countries, we've seen Delta and supply bottlenecks slowing growth in the third quarter, and Delta is picking up, or the virus is picking up again in Eastern Europe. But you know, there is a sense that with pent-up savings, the fact that many households, certainly in the United States, have brought down their debt levels, and if the Democrats pass the packages, there will be at least the prospect of fiscal transfers for a substantial period of time, as well as the infrastructure package. There is a sense that demand is strongly supported. And even though higher inflation is eroding real incomes, and there is the likelihood, the Fed already moved yesterday, of central bank action to slow demand, on net, we have greater risks of overheating rather than of falling back into secular stagnation. And so I would argue that to some extent, the views on inflation are dichotomous. One view is that everything is transitory. When all this dies down, we'll go back to the slow and low inflation. I guess the IMF coined the term lowflation of the post global financial crisis times. In other words, a belief that this time is not different, while many others, including me, believe that this time is different, especially given the massive fiscal support both post-pandemic and continuing to today. Now, on inflation, there's nothing that I can say that you don't already know, except I believe the aspects that are particularly different this time is the strength of the labor market. And it's not just because of transitory factors like, unemployment benefits or pandemic concerns or women staying out of the labor force. There does seem to be a big shift in worker attitudes. There are more and more people in the US, in the UK, who don't like high contact, low skilled jobs at low wages, and they worry about career progress. And that's reflected in the difficulty that people have of attracting workers to certain kinds of jobs, especially the lower skilled ones. There's also the fact that, the jobs aren't where the people are. In the US, for example, you see that, New York City still has unemployment of close to 10% because high contact services haven't opened up. While many other places, employers are crying out for workers, they simply cannot find them. This also means there's a transition required from waiter to welder, and that doesn't happen overnight. These may well be transitory because of the goods market has recovered faster than the services market, but the kind of transitions that might be required may take longer. And of course, when coupled with changing attitudes, it may be longer for a time in which inflationary expectations could get entrenched. But I would say the biggest reason to believe that there is a changed environment, a changed regime relative to the post-global financial crisis regime, is that on a number of issues, we have become more supportive of effectively higher inflation. Labor policy is much more geared towards workers. Minimum wages in the United States, more union support. Minimum wages have been going up, as you know. And post-pandemic, there is a sense that we must do more for workers, a public sort of view. And I think this will help keep wages higher. Of course, globalization has turned to more protectionism. Globalization was a force in keeping prices down. It's going to be less of a force today. Central banks have changed policy attitudes and in fact frameworks as the Fed has from the post-global financial crisis situation, partly as a result of not being able to achieve the inflation targets. For example, the Fed says rather than minimize deviations, it's going to minimize shortfalls from full employment. It's not going to be reactive. It's not going to be proactive on inflation. It's going to be reactive. These are big changes, and that does mean a more inflationary environment. But the biggest, I think, change is the fact that many now believe there are no constraints on fiscal policy, and therefore fiscal policy has become much more expansionary, partly because of economists like Olivier Blanchard, your predecessor, who emphasized the low level of interest rates and the ability to spend more. Of course, Olivier is I think, against the level of spending today. but he set the conditions for people to think more about expansionary fiscal policy. In a sense, central banks have been surprised by the extent of fiscal response. Let me add two more points, and then we can talk. The outlook in emerging markets is very different. I'm talking about emerging markets outside of North Asia. As you know, studies show far fewer people can work from home, and the virus and variants did a lot of damage in these countries. And the countries had very little monetary or fiscal room to prevent economic scarring. That scarring is below the water in a sense. What we see is the tip of the iceberg. Stock market celebrating in a number of countries, but there is scarring, and there is the fact that in a number of countries, certainly in the developing world, few have been vaccinated, and the rollout is slow. So even within these countries, there are big divisions. Large firms doing very well. I'm talking about India here. Stock markets are buoyant. When you talk about potential problems down the line, everybody says, "What problem? Everything is fine." But really, small firms have serious problems. If you compare the economic performance of large firms versus small firms, it's night and day. And of course, large firms have also used buoyant stock markets to pay down their debt. Similarly, upper middle class people have been able to work from home, lower middle class not so, and many have lost jobs. The World Bank and Pew suggest 75 million more people have become poor in India. That's a huge number, and these numbers are frightening, especially for children. Not only have they fallen back into poverty, but they've been out of school for 2 or 3 years. They've been out of school for 1.5 years, which translates to 2 or 3 years falling behind. How do you get them back to school, or do you lose a whole generation which isn't able to keep up? Many more marriages of kids in school, kids who should be learning rather than getting married. I'm talking about women or girl kids. And of course, for boys taken out of school and put to work in the fields simply because schooling doesn't matter anymore. So I think these countries have big problems. Last point I'll end with, China. I think China, again, the belief is this time isn't different, that China will figure out how to get growth back. The kinds of reforms it is undertaking, including in the property sector, they'll, may be disruptive in the short run, but they'll do what is necessary to get it all back on track. I worry that this time may in fact be different, that, the property sector has been critical to Chinese growth. And, it has built enormous amounts of hard assets, including housing. Ken Rogoff has a paper with a student which suggests that Chinese per capita square footage of housing available exceeds that of people in France. China still is nowhere near the per capita income in France, and the fact that housing is so plentifully available suggests there is overcapacity. And of course, China is getting old, the population is not growing anymore. And all this suggests that, yes, the property sector needed to be dealt with, but is the way that they're dealing with it likely to cause disruption? If property prices fall, if construction falls, a big support to the economy is taken out, but also it impinges on other areas. Local governments, for example, raise money for fiscal support by selling land. And if land prices are falling, it becomes less attractive to do it. And the worry is, this spills over more generally in China into slowing economic activity more widely. This is a question, we can debate it, but I do worry about these. Let me stop there, and perhaps we can turn to some other issues.
Thanks, Raghu. As expected, you kicked us off by talking about the most interesting issues that we have on our plate. So let me push you some on the first one, which is on the inflation discussion. And I guess here we're talking about, the US and maybe the euro area and some of the advanced economies here. So firstly, I don't think anybody disagrees that this time is different or that there is, we're in a changed environment. There are ways in which this time is absolutely different and we're in a changed environment. The question is, what are the consequences of the changes that we are seeing here? So maybe I have a couple of questions. So let me just list them all out, which is one, so precisely what do you have in mind when you say that that you think inflation, we're in a different regime for inflation, and it's not about transitory, even if it's several quarters transitory. It's not that situation. Are you talking about, say, inflation in the US going back to what it was in the 1970s and staying incredibly elevated and requiring some very strong action to bring that down? So we're talking about 7%, 8% inflation. So I guess that's the first question. What exactly do you have in mind for your inflation views? The second is in terms of the forces, right? So yes, indeed, we are seeing changes in the labor market. We are seeing a push for minimum wages go up and maybe a higher bargaining power at certain levels of wage skills. But again, as we know, these are all relative price movements, right? So we have wages of some going up. So what we know, for instance, just looking at least what on companies that are listed on the stock market, if we look at their earnings and their profitability, it remains extremely high in all these parts of the world, right? So you could very well see wages going up, but then that's just more redistribution away from corporate profits to workers. And that should not then necessarily generate a wage price spiral because companies have the ability to absorb it. And that's part of what we saw before this crisis, which is we saw that there was sensitivity of wage inflation to the output gap and to the tightness in the labor market. What we did not see was then that being passed through into prices. And the argument was that there was a big buffer with markups and higher profitability. And this crisis seems to lead to suggest that we are certainly moving towards higher automation, more concentration with all the small guys out. So, that force remains over there. So that's the second part. And the third is actually on issues like globalization, again, another real issue, which is the fact that we end up with a less integrated world, maybe less competition, less sharing of technology. Those have real consequences. The question is, how does that then affect inflation, right? Because we think of inflation as a consequence. It's a nominal concept. It's about the stance of monetary and fiscal monetary policy, especially, for instance, and of course combined with fiscal policy. Now, before the pandemic hit, we thought these forces still played a role and played a very important role in driving inflation dynamics because we had the zero lower bound problem, which is that when your real interest rates are very low and they're negative, monetary policy can't give all the stimulus that's needed to bring inflation back up. But in the opposite situation, where if the problem indeed is greater protectionism, because of which that's going to put pressure on real interest rates to go up, and then also put pressure on inflation, monetary policy is far more effective in being able to raise interest rates as much as you want. So what is your view then in terms of, so when you tell us your first answer to the first question, and exactly which parts of these arguments do you think break down, and why do you think that we're in a different regime? But
right. Great set of questions. Look, I don't know which regime we are in. Are we the 70s, the 60s, or some other regime? I think only time will tell. I'm not saying we will get double-digit levels of inflation. I am saying that we will exceed the inflation targets by significant amounts for sustained periods, and we'll have to bring it back to target, which means tighter policy. What I am worried about is that markets don't seem to be anticipating this tightening, and that there are many assets which are priced as if rates will stay low for really long. I mean, in this environment of potential overheating, seeing 10-year real interest rates in the US around -1% tells me something's not adding up. Either my economics is faulty, or the markets are either sort of valuing Fed credibility significantly and believing that the Fed will get things under control after a very short spike, or they believe something else will happen. And you can go through the list of scenarios. One scenario where the Fed starts raising interest rates, asset prices collapse, and we're back to the need for accommodation and low interest rates. So, I mean, there are various bad scenarios one could think of. I would argue that given what has happened in the past, the temptation for the Fed will be to stay on the sidelines longer than it would if it wasn't informed by what happened post-global financial crisis and by the extraordinary fiscal effort that has taken place now. If the Fed was to, in a sense, pull the plug on the economy and see it sort of slow down considerably, I can bet you every politician will be baying for the blood of the governors of the Fed. We spent enormous amounts of resources and enormous amounts of effort in getting this fiscal deal together, and you guys, by raising interest rates, have just brought the economy down. So I don't think any Fed governor wants to be there. And therefore, I would say the temptation will be to be more accommodative than you would otherwise be. I wouldn't say it's politically determined, but it's at the back of their mind is the political consequence of being of the risk that the markets react too much and sentiment collapses, and we're back to square one. So I think they'll wait longer than potentially they should. I mean, on the point that relative prices and that this should be absorbed by firms. I buy the point about relative prices, but what we're seeing is a more general, in my view, increase. Everybody thinks this is only the goods sector, but I have no doubt that it will spill over to the services sector. And then the question is, will the firms absorb them in the margins? But that's where the profitability should worry you, right? They're not absorbing it in their margins. They're passing it on. And the question is, you're seeing if you think prices, firms don't like to push up prices and then bring them down. The fact that so many areas, they are pushing up prices, including the restaurant sector where there are menu costs, they're actually pushing up their prices. These fast food joints, you have to start worrying that this is potentially more long term. On the globalization, I think the point there, which was more not so much that would hold down prices, but it would also act through the labor market, that you had a global labor market. And the fear that your jobs would get shifted to China or to Mexico held down wages in the US. And my sense is that's much less of a concern, given the kinds of political noises that are being made about any such activity today. And so it would be the brave firm which says, I'm closing down this plant today to shift it to Mexico or to, and I think that takes off a impediment to higher wages. Now, last point, I think post-global financial crisis, some of my colleagues have written about it. I wrote about it in a book. Part of the reason for low demand was, and actually, I think the first clear enunciation of this was from the IMF. Part of the reason for low demand was the distribution of income. And, when income moves from the poor to the rich, if it gets more skewed, the rich have a lower marginal propensity to consume, and therefore consumption is less easy to sustain. What we've seen in recent in the post-pandemic response is the reverse, and so I would say that's a good thing. It's good that wages and incomes are going up at the lower end, but it also makes demand, in a sense, stronger and more sustained than it was, post-global financial crisis. And that's another element that we should think about. We should celebrate the fact that income is equalizing a little more, but we should worry about the inflationary consequences.
Thanks, Raghu. I think I agree, and I think at the IMF we've been making this point that, regardless how we feel about the inflation numbers and where it might jump around, I think we all are in agreement that the markets seem to be priced to perfection, which means that it doesn't take much in terms of accidents or surprises to have some pretty big consequences, at least in financial markets, and then again, this spillovers to the real economy. So that agree on. And of course, I think the point you made also, that you said, you raised the concern that the Fed might be behind the curve effectively because of all of this new environment that we are in. But there's a question that came up on Q&A, which would be, I guess, an argument that might be made by some central bankers, which is that the reason we're being so incredibly cautious is because we want to solve the problem that we've also been fighting the past decade, which is of too low inflation. Yep. So maybe this is not a bad idea to actually bring inflation up to levels we would be happy with, which would then help us in the long run. And so, I think at this point, we're all very focused on the big numbers that we're seeing. But again, if you look at long-term inflation expectations, if you look at the past decade, they're all point towards inflation not being in the ranges that would make central bank policy that effective if things were to go bad in the future. So that's one point. And I guess, if you look at projections for global growth and so on, which translate in some measure of what the real rates might be, again, those are basically back at this point to pre-pandemic, would be coming back to pre-pandemic levels. So it's not like we think we're in a regime shift with big rise in productivity growth or any of those kind. And then last, Raghu, I agree with you on, there are all these forces, again, of globalization and so on that can have these kinds of effects. But you need the piece which also says that all these real factors will have big nominal consequences. And again, I think that while that argument was easier to make when the problem was of too low inflation, I think it's harder to make when you have too high inflation. But again, let me hand this set of questions to you.
Let me just take the discussion to a somewhat different point. Look, first, not everything is on the table is inflationary, right? We talked about China. China will be deflationary if China if China has more serious problems than we think as of today. And so, yeah, that's one concern. I think there are two other effects we shouldn't minimize. One is, of course, the financial sector. We talked about it. What if asset prices react to the prospect of higher inflation, nominal interest rates go up at the long end, and asset prices, especially of tech stocks, come down to earth. Cryptocurrencies, $2.5 trillion. What are they worth? They're pricing in some sort of future where everybody uses cryptos and cryptos make money. I don't know what that is. I can visualize some uses, but that's another concern. But I would also point to the effect. We are primed for a low nominal interest rate, low real interest rate world. And what if both sort of move up? And our fiscal situation is not to be, you shouldn't forget that we have a lot of debt outstanding on the fiscal side. And so immediately the response is, well, it's long-term debt. It's not. That's the reality of what's been happening over the last few years. Take, for example, the UK, and I was just amazed by these numbers. Average maturity of debt, 15 years, right? Now, but average maturity, there's some 30, 40, 50, even console bonds in the UK. And there's a lot of short maturity stuff also. So when you look at median maturity, it goes down to 11 years. That's still fine, right? 11 years means 1/11 turns over every year, is repriced at new interest rates. Not too much of a worry. But then you subtract what the Bank of England has bought, because that essentially converts longer term debt into overnight debt. And the median maturity comes down to 4 years. Now, 4 years median maturity means a significant part of your debt is repricing every year, especially because there's a lot more short-term debt concentrated there. And it turns out if interest rates go up 100 basis points, almost all the fiscal normalization that they have goes out of the window, offset by these interest rates. Now, that's for the UK. For the US, you start with average maturity 65 months, okay? And then do all the subtractions and get down to median maturity, et cetera. My suspicion is the US has a lot more short-term debt waiting to be repriced if interest rates go up. That has fiscal consequences. We're adding to the fisc right now with all the spending that's taking place. But, who knows what happens when these rates go up and what kinds of political reactions there are. The broader point I'm making is I sort of agree with you that we're not talking about hyperinflation. We're talking about an inflationary environment, but what I'm saying is we're used to a non-inflationary environment, and some of the adjustments we will make in the process may create forces that we haven't been used to, essentially deficits that are harder to finance and larger than we expected, and financial market reactions that will require, the leveraging that's happened in the financial markets, yes, outside of the banks, but we'll find out who's been swimming naked when financial market prices adjust.
Thanks, Raghuram. We're getting some great questions both on emerging markets and debt, and I'm going to come back to debt, but sticking to what you just ended with, firstly, your views on inflation concerns in emerging markets. Of course, there's a big range of them, but you can pick whichever you want to feel comfortable talking about. And also, more generally, given what you just said, do you think that emerging market policymakers are maybe then a little, maybe too sanguine about the risks of very large tantrums in financial markets and so on that could emanate from the US? And given you've been a central banker, what would be your policy advice at this point in an environment like this for emerging markets?
Well, emerging markets don't have the credibility that industrial countries have, partly because of politics that have been fractured over time. Now, emerging markets have done a lot to build up stronger institutions, inflation targeting central banks, and so on. And you can see, for example, in a country like Brazil, the tension this is causing, right? On the one hand, on the political side, spending is taking place, breaking some of the fiscal rules that were in place. On the financial or the monetary side, the central bank is saying, therefore, we're going to raise interest rates. So unlike the industrial countries where there is sort of cooperation between the central bank and the political establishment, at least at this point, in trying to get the country out of the trouble, these different sort of pressures on the political side and on the monetary side, given that Brazil has an inflation targeting central bank, are creating a pretty substantial tension in Brazil with interest rates moving up pretty rapidly. and inflation, of course, also moving up. So I think emerging markets have much less policy space with the high levels of debt that have built up, with the rising inflation. They have to act. But the biggest problem is the kind of damage that has been done to the lower middle class is creating, radicalism in these countries. Not every country, but certainly in a number of countries. Take, for example, Chile, where you have people, candidates from the extreme left and the extreme right running for president, whereas the middle, it's overshadowed by the problems that, have been building up in Chile for some time. And of course, Chile's wanted macro stability is also, being threatened by the need to react to the pandemic. Their pensions, for example, they're taking out of them to spend. So I think that what we're seeing across the world is that the emerging markets and developing countries, let's not forget them, are going to be coming out of this pandemic with a lot more damage. And the damage, is in the informal sector, it is in the lower middle class, and therefore it's not so easily observable. When I talk about the problems in India, people sort of, essentially criticize me for being negative. And my worry is we don't know the true extent of the problem, since a lot of actions during the pandemic have worked towards masking the problems. For example, on NPAs, we've postponed recognition of NPAs. And the true extent of the problem only comes to light a year or two down the line once the rebound has happened, which seems to suggest everything's all right, but then you see the sustainable growth. So that's another deflationary or disinflationary force that I think will play out. Again, to your point, that should we be overly worried about inflation over the medium term? Perhaps not, but a lot of things need to adjust, and that adjustment is what worries me. Will it happen in a reasonable way?
Raghu, did you want to weigh in on your, central bankers? What should they do if you're an emerging market central banker?
Well, I think at this point, if you're a central banker, you have a pretty clear mandate, and you should worry about that mandate. The problem, to some extent, is your temptation is not to pull the rug. To again, similar to the Fed, you don't want to be accused of hurting the recovery. And the reality is the recovery, after the initial rebound, is going to be slower. So the question is, how do you manage this process? I think most central banks will play for time. They will want to act as if they're doing something. They will lay out a path by which they do these things, but they will try not to get too over tighten while they still have any room to play with. Now, some emerging market central banks don't see any room. Inflation is already way beyond what their mandate suggests. And so, in a sense, if they respected their mandate, they have to actually act. And we're seeing that happen, again, for example, in Brazil. But I think where they have any room, they will play. Again, suggests short term, we will be more inflationary than otherwise.
Okay, Raghu, sorry, I'm pushing you on this, but what would you want them to do?
I'm not disagreeing with that approach. Partly, again, you don't know the extent of the disinflationary forces that will emerge down the line from your own economy, because there's more damage under the hood, and so you don't want to react to the rebound, which is happening, which suggests strong growth, and with the supply chain problems, which will potentially elevate prices in certain areas. You will wait and see what happens beyond that. Now, again, I would say we don't really know how much damage has been done, because a lot of it has been covered up. I believe there is substantial damage, and therefore, medium run in these countries, there will be more disinflationary forces rather than inflationary forces. But we don't know, and I think they will play for time so long as they don't look ludicrously out of sync with the current outlook.
Thanks, Raghu. On the question of debt, you raised the point that debt levels are incredibly high. It's true, we're at historic levels. Debt to GDP is public debt to GDP is 100% of, you know, we also have central, and the other point you made was that the bloated central bank balance sheets, like you said, everybody's been buying, central banks are buying government debt. So two questions. One, you know, what is the best strategy for advanced economies and emerging and developing economies to reduce the public debt vulnerabilities? And second, are you concerned about central banks having very large balance sheets and that could affect their ability to do sound monetary policies and so on?
First, let me start with what one might want to do. I think one would want to do the exact opposite of what modern monetary theory would suggest. Don't finance the government budget anymore with effectively money printing. Issue 30-year bonds, 50-year bonds, 100-year bonds right now while the markets are still accepting of it, and lengthen the maturity of your balance sheet. Of course, it might come at the expense of some investor on the other side. But if you want to stabilize government balance sheets, lengthen maturities as rapidly as you can, while the QE is still on, while you can sell the debt, and for God's sake, don't focus certainly on shortening those maturities. From the central bank perspective, buy shorter maturities right now rather than buying longer maturities. Of course, the hope is that the long end doesn't react while you do this, but that's why you don't announce it, but you do it as quietly as you can to lengthen maturities. From the central bank perspective, I think the question on central banks was.
It was about, we have the process of buying a lot of this debt has meant that we have the central bank balance sheets have grown. Right. There's always been this question of where does you stop, right? Like how big should the central bank's balance sheet be? And should you start actually consciously trying to run it down? Right.
So I think there are two issues here. One is what Viral Acharya and I call liquidity dependence, which is, the view was when the central banks expand their balance sheets, that, this is a good thing, that this provides a lot of liquidity to the market. In a sense, it's the Friedman rule, right? Supply liquidity because there's no cost to supplying liquidity, and do a lot of it so long, to the point that the market is satisfied. My worry is that the market is never satisfied. That what happens is the liquidity that the central bank provides is first offset by the way the commercial banks finance that liquidity, typically by issuing wholesale deposits, and you can see it over QE1, QE2, QE3. That's how it was financed. But a wholesale deposit is a claim on liquidity under certain conditions, right? And so what we're seeing, interestingly, is these liquidity episodes where liquidity sort of dries up in the markets. We saw it in September of 2019, way before the pandemic. And of course, we saw it in spades, the dash for cash in March of 2020. And so our argument is the liquidity that is supplied is offset by a huge number of new claims on that liquidity, so much so that it's very hard to pull back. Where today, Darrell Duffy and others, when they talk about the excess liquidity in these markets, are saying, let's supply more. And of course, conditional on where we are, supplying more makes sense. But what we're saying is that is going to create more demands. And the private markets are never going to have enough. They basically, liquidity sitting on a bank balance sheet is needs to be used. Otherwise, the banks are letting a resource lay idle, and they do use it. But that means that nothing is really left when push comes to shove. And so I believe that we're ratcheting up the levels of central bank balance sheets. We had 800 billion, I think, pre-global financial crisis. In 2018-19, a balance sheet 4 times that size was not enough to prevent liquidity shortfalls. And now, of course, we've got significantly bigger than that, but I think the private markets will adjust, making it more difficult for us to go back. But we should. I don't think it's the central bank's role to continue providing liquidity, and the private markets should get used to not having so much around, but it's easier said than done because the private markets have become dependent. So, bottom line, I think quantitative tightening should happen at some point, but it has to be handled very carefully because it's not as easy as we think.
Thanks, Raghu. This is a really interesting point because, yes, this was a view that was put out, which is that there's such a huge demand for safe assets that central bank liabilities provide those safe assets. But what you're saying is that just feeds into then greater demand for creates other kinds of liabilities that feeds into greater demand for safe assets, and it's a bit endless. Let me switch topics to the world of cryptocurrencies and stable coins and central bank digital currencies. So where do you come down on everything that's going on these fronts? And especially, I mean, I'm also keen on the central bank digital currencies since that's getting a lot of attention these days.
So I think that cryptocurrencies are very interesting. I wouldn't clamp down on them if I had any say in the matter way back. But I wouldn't have let them go to 2.5 trillion without quite figuring out what the use case is. I think there are sensible use cases. It's not about hyperinflation, or it's not about using it for illegal activities, but it's about cross-border payments. It's about micropayments. It's about contingent payments. Delivery versus payment, for example. It's about setting up contracts which don't need an external enforcer, but where the software itself can do the verification and can be protected, from both sides from alteration, and that can build cross-border confidence in cross-border transactions. So there are use cases. Do we see a big use case as of now? I don't think so. And so what worries me is the tremendous valuation. And some of the arguments for the tremendous valuation make no sense, right? This is in short supply. Of course it's in short supply. That's because you fixed it at 21 million Bitcoins. But there are so many other cryptocurrencies available. So what's in short supply? Certainly not the payment media. There's plenty of payment media around. Moreover, if the value is going to come from payments, that seems for me hard to buy. I mean, it has to be everything surrounding payments rather than payments themselves. And then there's deep questions which authorities would like to know. How you handling the data? Are the data widely available? I mean, today, authorities across the world aren't willing to let private agencies monopolize the data, and over time will force those guys to disgorge the data more widely. So you're not going to become the new Facebook by starting a cryptocurrency, even if you manage to dominate the payment system. So that's by way of preliminary. I think there's a potential use case for micropayments and so on, but I haven't seen it yet. They're working on it. More power to them. Let them work on it. I do worry about valuations when we don't have a use case. Second point, the fact that we have CBDCs. That's the other worrying thing for cryptocurrencies, that CBDCs, central bank digital currencies supported by a central bank which maintains value, may perhaps dominate things like cryptos or stable coins in making payments. And so, if these things get big enough, the central bank wants in. And that's exactly what you see in China, that with Tencent and Alipay dominating the small retail payments there, The central bank is saying, we worry about this. A big private player occupying a big part of the payment system, we want in. And so the Chinese have the digital yuan, which is certainly on the cards for the Winter Olympics. And they're asking more and more people to use it. Of course, the CBDC raises huge questions, right? What is the government going to do with the data? The Chinese have a term controllable anonymity, which I find Orwellian. It's anonymous until I want to control you, and then it's no longer anonymous. I would prefer layers of protection, including judicial layers, between what is gets to be known from the data from the CBDC and what the government gets to know. Otherwise, we move into a more authoritarian structure. But the CBDC has other big consequences. For example, you're very worried in the IMF about dollarization. Dollarization becomes so easy with the CBDC. Already you're seeing cryptos dollarizing many poor developing country economies. That's a huge worry. The crypto is more trusted than the local currency. Shame on the local currency for being less trusted than a crypto, but it is a worry when the digital yuan or the digital dollar come around. Will we get much more dollarization? Even within the country, there could be an effective form of dollarization if, at the hint of a crisis, people move immediately into the CBDC away from the bank deposits that they have. And that run on the bank would be extremely costly. The ways of dealing with it, for example, limit the size of the CBDC account and so on. But that requires, at least at present, sort of information on the identity of the transactor and the size of the wallets they hold and so on. So lots of issues, they need to be solved. And of course, there's to my mind, a huge issue, which is hacking. What if your CBDC is hacked, by a quantum computer, which has much more capacity than, I don't know. It just strikes me that we have a whole lot of possibilities with the CBDC, but a whole lot of challenges, and we need to solve them. I think we need cross-border dialogue on it. And I hope the BIS and the IMF will encourage more cross-border dialogue on the rules of the game, because everything that we can do now in cross-border flows explodes once you have the CBDCs which can be used across countries. And so we need some rules there.
Thanks, Raghu. I think I share the sentiment that sometimes, why do we have a $2 trillion solution for a problem we can't identify yet? I think, including the implications for the environment in terms of Bitcoin mining and all of that. I think there's a question of, are we being a bit too eager in the sense of saying, let's see whether there's some possible benefit that can come out with some innovation that can come out of it, and letting this run. And maybe there should have been regulation at an earlier stage. Okay, we have only about 5 minutes left, so I'm going to leave you with a last question, which is, love to hear your views on how you think the global community, including global institutions, including MDBs and IFIs, how do you think they've done during this crisis? What has worked and what has not worked? Where did we have the failures, and what needs to change?
I would say that we are still extremely dependent on US leadership in the global environment. At least a US leadership which is not an impediment, but a supporter for global action. That was not the case at the beginning of the pandemic. And I think that showed in the very muted response of the G20, unlike the post-global financial crisis response, certainly led by Gordon Brown. I think he showed leadership at the right moment, but supported effectively by the US. I think when the current institutions are structured with the US taking a major role at the center. And if the US backs off from taking that role or even obstructs or plays it on its own, I think it's very hard for the institutions to ramp up their game. They can, and the IMF has done some of that, but it requires support. Which leads to the question: how do we, future protect or future proof the global institutions against so much reliance on the good offices of one country? And I think that needs to be thought through as we go forward. How do we, accept a multipolar world, but recognizing that the U.S. brings a lot to the table, and how do we change? And I think it's important for the U.S. also to recognize the need for that change, to accept that it's in its own interest in some ways that its volatile politics doesn't impact these institutions and create a volatile world environment. That said, I think right now the press is in the right direction. I think far more has to be done on vaccine production and distribution in the developing countries. It would have been nice if both the financing as well as the impetus to create production there was there right from the beginning. But of course, better late than never. And of course, some of the therapeutic treatments, we should make them as widely available as possible. It's, I think, was it Merck, which is now entering into licensing agreements across the world. I think that's a step in the right direction. And I would hope that the countries that can produce more of it are actually joining in a big way to spread it across the world. So I think better, it is late. It would have been nice if it had happened earlier, but we need to think about what lessons this gives us for the future.
Thanks, Raghu. And I do believe that at least when it comes to some of these therapeutics, the new antiviral, the Merck antiviral, there is hope that it will not go the way of the vaccines, which was terribly inequitous in access. Now, the problem, of course, is that those antivirals work very well only if you can detect that you got COVID very early. So that means more testing. And unfortunately, there is a deep inequity in testing around the world. So two problems will have to be solved at the same time to make this work. But thank you. I think we're out of time, but we've covered a lot of ground. I think there's no doubt that this will continue to be interesting times for many, many months and quarters. Let's hope it's not so interesting on the pandemic front, that we actually we're durably exiting this, even though at too slow a pace relative to what could have been accomplished, and that there's more action happening now to get more equitable access to vaccines. But again, it's a bit of it was a lost 10, 12 months that we're trying to make up for at this point. But yeah, again, and one of the points we've been making is, Raghu, something you said at the beginning, which is that the story for emerging and developing countries, for many emerging and developed countries, not all, but for many emerging and developing countries, is different. And that's what we're seeing now, which is that while we project advanced economies to be back to pre-pandemic path, no scarring by next year, we have significant scarring for many emerging market and developing economies, which is quite the opposite as after the global financial crisis, when it was all a problem for advanced economies. So that is a big issue that we will have to deal with. But thank you so much for your time.
Well, before I end, let me just wish you happy Diwali and wish all the listeners happy Diwali. This is, of course, the biggest festival in India. So happy Diwali to all.
Indeed, happy Diwali. And thank you. Thanks, everybody, for joining.
Thank you, Gita and Raghu. This was fantastic. I think Raghu was unstoppable. So thank you very much, Raghu. Great to see you.
Bye. Thank you for having me.